Over the past decade, dividend-focused ETFs have ballooned to over $300 billion in assets. And here's the kicker. Investors who consistently reinvest dividends have outperformed the broader market by as much as 40% in total return. If your goal is to retire rich, it's not about picking the hottest stock. It's about choosing the right dividend ETFs that quietly compound your wealth over time. Most people think the only way to play dividend ETFs is through giants like SCHD, VOO, or DVY. Don't get me wrong, they're solid choices, but if you only stick with what's popular, you may miss out on funds with higher yields, better growth strategies, or unique features that can build long-term wealth even faster. If you enjoy this kind of content, please like, share, and subscribe. It helps us reach more dividend ETFs investors like you. Quick reminder, this video is not financial advice. Investing in stocks is risky. Always do your research before making any decision. Imagine building a portfolio that doesn't just pay you every quarter or every month, but every single week. That's the promise behind WPAY, and it's one of the most exciting new dividend ETFs on the market right now. This isn't just another yield play. It's a brand new structure that changes the game for income investors. WPAY is the first ever fund of funds in the weekly pay lineup. Instead of forcing you to pick between single stock covered call ETFs like NVIDIA's NVDW, Tesla's TSLW, or Palantir's PLTW, WPAY rolls all 15 of them into one ticker. With a single trade, you get instant diversification across big tech, AI, semiconductors, fintech, and even high-risk/high-reward names like Coinbase and Robinhood. And yes, you still collect those famous weekly distributions, with yields topping 30% annually. What makes WPAY truly stand out is the rare balance of income and growth exposure. Most dividend ETFs force you to choose. You either go after the high yields of covered call strategies but sacrifice growth, or you stick with safer dividend growth funds that pay modestly while you wait years for compounding to do its work. WPAY breaks that mold. You're tapping into some of the fastest-growing companies on Wall Street, names leading in AI, cloud computing, fintech, and semiconductors, but instead of waiting years to see the payoff, you're literally pocketing a paycheck every single week. And the structure matters. WPAY rebalances monthly and runs on an equal weight strategy, meaning no single company dominates the fund. That's critical because it protects you from being overexposed if one stock stumbles. In other words, you're spreading your risk while still enjoying the upside potential of growth leaders. Add to that the fact that this ETF is delivering yields north of 30% annually. And suddenly you're looking at a fund that doesn't just drip income, it gushes it. Now yes, the expense ratio comes in higher than your plain vanilla index funds at around 1%. But that's the trade-off for what you're really buying here. Convenience, diversification, and a steady weekly income stream that almost no other ETF on the market can match. For investors who want cash flow now and growth for later, WPAY hits both goals in a single ticker. For long-term investors looking to retire early or simply enjoy consistent passive income, WPAY could be a game-changer blending cash flow with exposure to some of the most powerful growth stories of the decade. Now, while WPAY is all about turning dividend investing into a weekly paycheck machine, ETF number 2 takes a very different approach, but one that's just as powerful for building long-term wealth. It's the Invesco S&P 500 Momentum ETF, ticker symbol SPMO. SPMO isn't your typical dividend play, in fact. The dividend yield itself is modest, usually under 1%. But here's why it earns a spot on this list: total return. Since its launch back in 2015, SPMO has delivered an average annual return of more than 18%, crushing the S&P 500's historical average of around 10 to 11%. That's the kind of compounding that can take a portfolio from 6 figures to 7 over time, even if the dividend checks are smaller. The secret lies in its momentum strategy. Every 6 months, the fund scans the entire S&P 500 and selects the 100 stocks with the strongest momentum scores in plain English, the companies showing the best recent price performance adjusted for volatility. That means you're always holding the market's biggest winners, and the laggards get kicked out at the next rebalance. It's like having a built-in trading algorithm that keeps your portfolio focused on strength without you lifting a finger. What's even more impressive is how it performs during bad years. In 2018, when the S&P 500 dropped about minus 4.5%, SPMO only slipped minus 0.9%. In 2022, when the S&P sank nearly minus 18%, SPMO was down closer to minus 10%. In other words, you get higher highs in good years and smaller drawdowns in bad years, a rare combination that makes compounding much smoother. The expense ratio is lean at just 0.13%, making it even cheaper than popular growth ETFs like QQQ. And when you look under the hood, you'll see exposure to some of the strongest sectors driving today's market information technology, consumer discretionary, financials, and communication services with top holdings that include names like NVIDIA, Meta, Amazon, and Broadcom. So, if WPAY gives you frequent cash flow, SPMO gives you the engine for capital growth. Pair the two together, and you've got income today plus massive appreciation for tomorrow, a powerful 1-2 punch for anyone serious about long-term wealth. And that brings us to ETF number 3, a newer player that's starting to get serious attention from dividend investors, BTGD, the STK'd 100% Bitcoin and 100% gold ETF. Now, don't confuse this with a YieldMax fund because it's not. BTGD is something different. Instead of selling options for income, it's designed to give you leveraged exposure to two very different asset classes at the same time, Bitcoin and gold. Here's why that's interesting. Bitcoin is one of the most volatile assets in the world, while gold is one of the oldest safe havens. By combining the two inside a single ETF, BTGD is essentially trying to give investors a way to capture upside from crypto growth while balancing it with the stability of gold. The fund is actively managed and rebalances between these two exposures, aiming for long-term capital appreciation. In other words, it's not about chasing weekly income like covered call ETFs. It's about riding two powerful but very different market cycles. Of course, there are risks. Because it's built on derivatives tied to Bitcoin and gold futures, performance can look very different from holding spot BTC or physical gold. The expense ratio is higher, and if Bitcoin crashes, you'll still feel plenty of pain. But for investors who want something truly different, a single ETF that mixes digital growth potential with a hard asset hedge, BTGD, is one of the most unique experiments in the ETF space today. So, when you put it all together, WPAY gives you instant diversification and weekly income from America's top companies, SPMO delivers pure growth through momentum, and BTGD turns crypto volatility into cash flow. Three very different funds, three very different strategies, but all working toward the same goal: long-term wealth through smarter dividend investing. And here's the key takeaway: while SPMO and BTGD bring massive upside in different ways, the standout for me is still WPAY. It's the first fund of its kind. It pays you like a paycheck every week, and it bundles market leaders under one ticker. For long-term dividend investors, that's a foundation you can actually build around.